back, guys and girls, to episode 2 in the quick tip series. Really excited to get into this one, which is the 1 hour retrace. So again, this is a question I get a lot, and I think this is an area where people overthink it. So I want to show you a few examples in which that it's good for both management and for entry. And I want to show the difference between when it's not that great to use it and when it is really good to use it. So let's start off with dollar yen. So within this particular section, what we're going to look at is a retrace candle within the structure. So naturally, on the higher time frame, we can see this ascending channel moving to the upside. Naturally, the best possible opportunities to be selling this would be after it's broken this high. It doesn't mean there isn't any opportunities within the channel. We just need to be on the management game. So what can we look at? Let's go to the 1 hour chart. So in this case, we're going to look at first an entry style. So as you can see within this area here, we have this 1, 2, and essentially the third touch on the trend line within that area. So what we're going to be looking at naturally is any kind of corrective nature or any kind of retrace. Now, when we talk about the retrace candle, it doesn't necessarily mean that the retrace is the exact size of the previous body. So all it is when we get a green candle, an impulsive candle, normally the size of this kind of green candle here. So it can be a little bit smaller, but something that's very obvious that moves up, and then the next hour normally it completely retraces or a little bit more. So as you can see in this type of situation, it's all to do with why are we looking at the trade? Well, we're looking at the trade because we have 1, 2, 3 within this ascending channel to the downside. We're then looking at what would we need to see to, let's say, enter the trade, right? So when looking at it, we can see the move up and then we see the retrace. Now this one in particular is slightly larger, so you can see that this is larger than the previous body. Now it doesn't mean that it's not a retrace, because the market's imperfect and we can't look for this picture perfect. A lot of the times they are pretty good. When you can see within this type of situation as well, if this candle formation was in this area, that would still be valid. Even though you can see that that red candle there, it didn't completely retrace, did it? But at least if it retraces over 50% of it, it's valid. So keep it as simple as that. This is what I would call, let's say, a slightly uglier version of a retrace candle when you're going to look for that for an entry point to sell. And how you take those trades is by having them either below the wick or on the body. Both are absolutely fine. What you just need to remember is that the wick sometimes can be, 10 pips, so you have to have that extra. I personally prefer to take them on the body. After a lot of back testing before, I used to have them below the wick, and then I realized you just don't need to, because after the retrace candle, they're normally very, very good turning points, either for entry and for management, that you can have that better stop. So in this type of situation, if you was to take this one, you would put it here, like this. You'd have your stop above, probably about a 25 pip stop, and then your target would be down here. You would probably end up taking this as a break-even trade. So as you can see, just keep it as simple as that, and this is just an average example of what I would look for. Now let's take a look at something a little bit better for both management and entry. So now let's take a look at a management style with the retrace candle. Now with certain pairs, they happen a lot. Euro dollar is one that you've probably heard me mention a lot of times. We do get the retrace candle and we use it for both management and entry, and I really do like it. So in this type of situation, we have to look at the high time frame pattern. So if we take this back just ever so slightly, looking at this structure here, when looking at this, we would be looking at this to potentially look for this extended trend line. We wouldn't have had this line in just yet. We'd be looking at this potential pattern here. So naturally, after this impulse up, there may be continuation to complete and potentially break this high and go a little bit higher. So we're looking for buy setups. But when we go to the 1 hour chart, you can see this continuation to the upside. So when we're looking at this continuation pattern here, this falcon flag, where we have the impulse, the correction, the impulse, and the retrace, we're looking at this continuation. So when looking at the first trade, we're taking this as a typical risk entry, which goes back to entry types as well. What are we looking at here? It doesn't always have to be a retrace candle. It can just be low momentum candles within this area, as you can see. Very, very simple, just low momentum within here. So naturally, buying this as a risk entry, you'd be taking it like this. So this is where the management style comes in. If you're taking it as a risk entry, 20, 25 pips, you're looking left and saying, well, there's previous highs. I'm looking to target around that area as a minimum, and it could go a little bit higher. But just in case, it doesn't have to get there. It could create a deeper structure. So what do we do in that situation? Well, we're tracking it accordingly. We can see we get the impulse, the correction, the impulse, there's a correction here, the impulse, and it's starting to get a little bit tighter. So naturally, we would have a trend line like this as that moves. And then we're looking at it in the form of, well, this is kind of rising like an ascending channel. It's not really that impulsive. So at what point would give me the signal to say, right, trade's over, essentially, and this could really pull back? What I'm looking for in my management is that retrace candle. So as we look in a little bit further, we can see at this point here, we get two sections. So let's move this out of the way. We get our first point here, where we get the 1, 2, 3. This would be the retrace, in which that you'd have the point in which that you're not actually always closing your positions down. You're just locking in just in case because of the unknown. This is really important for this reason. Because when you're trading, nobody would know how deep a pullback can be. You have to approach your management in a way that it's congruent with scale. So what I mean by that is that some people, they look at trades and think, you know what, I managed that a little bit too tightly. If I would have been more conservative, that would have gone on to make, let's say, an extra 7 or 8%. But the reality of it is, that may be true when you're trading £1,000, £2,000, £5,000, £10,000. But if your goal as a trader is not to turn 2,000 into 100, it's to scale your account. So you need to think of it like this. If you was trading 10 times, 20, 30 times what you're trading now, would you be comfortable that pulling back from, let's say you're in a 10% position or 7% position and it pulls back to 1% to then continue for that bigger trade? Would you be comfortable 7 or 8% being wiped back up before you then take advantage of the trade? Now you might think, well, you know what, I would be on £1,000 because, you know, it's not that much money. Well, what about when that trade that was running, you know, let's say 50 or 70 pounds is now running £70,000? Are you going to let that profit pull back to then £1,000 before continuing for the bigger trade? Probably not, because there's always going to be some element that you are emotionally involved in money, because naturally we're not robots. That's not the end goal, to become robots. So this is where the retrace really helped me out, as I've realized it's really good for picking turning points within the market. So rather than relying on, you know, what might happen, I'm going to go with what's logical, what's been back tested. So you can see the 1, 2, 3, the retrace candle. First point of confluence there that we'll be looking at is that this is this downward sloping trend line with a pattern, and then we're looking at it from a perspective that, if we just bring this in here, we're looking at it from the perspective that, look, we have the retrace. So what I'm doing is I'm going to lock in profit just below it, and then I'll let the market decide to me that, right, this is a turning point. Now, sometimes it's going to tag you in and go a little bit higher, and you're going to think, well, if I was a bit more conservative, then if I left my stop, let's say, here, it would have left me in the trade and it would have gone up a little bit higher. But then it goes back to the same thing. You're looking at that percentage and you're not thinking about scale, because what if that, just that area there, imagine just from here to here was an extra £15,000, right? Let's be completely blunt about it. If that was that, would you be comfortable that pulling back? What about if that's 30,000, 40,000? These things, this is what influences people. And I've seen this happen with so many people where their management changes. They're very, very conservative. They let these things, and as soon as they start trading more capital, they then have a bit of a wobble. It's because the way they were doing it in the first place is not going to be good for scale. So the way I do it is always good for scale, which is why I talk about the retrace a lot. Even if this one kept you in, you kept it a little bit like this, we can see it trickles on. Let's say it kept you in just, or it would have taken you out for there. As we move higher and higher, we can see we start to get these retraces there again. So what I found, even with these formations, we get the retrace candle a lot. Now, what would have been even better is, of course, for this to break the high, but you can see overall the retrace points are really good turning points within the market, or the start of what will be the turning point. So essentially, this was the first significant point, this was the second significant point, and this was the third one. So this comes at no surprise that this actually went a little bit higher, because this completed this pattern for the 1, 2, 3, and then, of course, then started to drop to the downside and then create more of a correction sideways. So when we see these type of formations, you need to realize the reason why I use that type of exit with management is that it's always helped me to pick the turning points in the market, and then I'm not just thinking with the unknown that, hold on a minute, well, what if it goes higher? What if it doesn't? What if it pulls back from you being in 7% profit to 1%? That is where people become emotional. So I would rather take a little bit less profit, knowing that I'm not exposed to just the pure unknown. Because as a trader, we're working on probability, not greed. So you see that? That's where it really stems from. So from a management side, it's really, really important to lock in that profit and utilize the 1 hour retrace for your management as a tactic. So I hope that helps give you a little bit of perspective on why we do it and why it's important. And I've found it to be massive within my trading, an absolute game changer. So now what I want to show you is a entry point within a few other confluences with patterns within patterns. So let's dig into that in pound dollar. Now we can see why we use the retrace for management. It really does help. But how do we use it for entry types? So what I want to showcase is the importance of understanding the phase. So at this point, we're going to look at a pattern within a pattern of how we can utilize the 1 hour retrace, but not so when it's picture perfect. How do we know when to read between the lines and realize that it looks like slightly something else, but it's still the same concept? So firstly, we can take a look at this particular structure and see that we have broken high in this type of situation. So naturally, this pattern with the 1, 2, 3 is a higher probability to play out. So what that does is it gives us an indication that this move to the downside could be very, very impulsive. So is it understanding the impulsive phase and using the 1 hour retrace for entry is absolutely key. So when looking at this now, we're looking at the overall move for this as a impulse, correction, impulse. This is just a bigger continuation to keep dropping. So when we zoom in a little bit further and we look at this 1 hour retrace, we have the pattern within the pattern. But in this type of situation, you can see that we have this. We have the impulse, we have the hanging man, and then we have the retrace. So it's not an impulse and then the 1 hour retrace completely next to it, but it's the one candle after. Now the question that some people ask me to say that, is that just still valid or is this invalid now because it wasn't next to each other? This is where you have to read between the lines and realize the market is imperfect. It's not picture perfect every single time. And you need to realize the key points is the fact that we have the arcing nature, the double top, it's in the impulsive phase, it's got the impulse correction, and you're trading it within the pattern as a risk entry using the retrace. Now you see here, we have the impulse, the high test, doji type formation, and the retrace. Notice that the retrace, that red candle, is a lot bigger than the green candle, but can you see that's just completely retraced the move? It's the psychology of what it's doing. It's getting people caught on the wrong side and then coming straight back into the pattern. It's the same thing here. So how you take that type of trade is, again, you can take it either below the wicks like this on the break, or you can take it on the body. Now, a lot of the times the wicks, they're not very big at all, so you can take it just below. But again, just as from a consistency point of view for me, personally, I've just found literally when you see the retrace, whether it's side by side or there's a reversal candle within that, just literally take it on the body. The important thing to understand here is the fact that this is a reversal formation from a candle shape perspective. So whether you've got the green and the red right next to each other, it's what you should be focusing on is what area am I looking at the retrace? We're looking at it as a double top within the pattern, arcing nature as a continuation pattern. So naturally, that is a great high probability setup with your stop just above for about a 30, 35 pip stops, absolutely fine. You can see it's above this high as well. And then you take that continuation. So you can see how you can use it as turning points within the market. Now you can see in this situation, the reason why this is unique is because when you look back, you can see that's not the most corrective move up you see, is it? But it's the impulsive phase that takes over. It's the fact that this potentially is the impulsive phase because of the higher time frame structure is suggesting that this move to the downside, broken the high, 1, 2, 3, bigger double top, and the drop. So you can see how the 1 hour retrace here, it goes back to what are the quality of your setups? What is the quality of your setups and how are you using them at the moment? Are you literally just looking at a 1 hour retrace anywhere within any kind of formation and seeing it as an entry? Or are you actually looking at the bigger picture? So it goes back to how you really take advantage of the 1 hour retrace is the higher time frame, drilling down and the refining that process. But then also understanding that it's not always picture perfect, and you have to know how to read between the lines. So I hope that helps, and you're going to see that more and more. As an actionable step, what I really highly recommend is you now look through old trades. Look through trades that you've managed. Let's say you've managed them well, or you've managed them slightly poorly, to see that retrace and see how common it is within those retraces for your management and both entry. You're going to find now, when you're looking at the markets, you'll probably see that quite more commonly. You hear me talk about it in webinars a lot, and it's important that you see it in a point of scale. That's why it's so beneficial. Sometimes, yes, it will retrace, and then you'll close a position, and it would have gone on to make, an extra 3-4%. But it's about scale. And the more and more that you can protect yourself from the unknown, you'll always have your psychology protected, which is far more important for scale. And then what we can do is then forecast these turning points within the market to then maximize as much profit without letting that greed come in. Because the only reason why sometimes we get a little bit frustrated that we close the position down, because we see it going for a little bit more profit, and it's really the greed that bothers us. Because I've seen some people that have banked 10, 15, 17, 18% in a month, and then when they hit a 7% month, they feel like they're doing something wrong. And then they're not grateful for the fact that you've just made, you're consistent, you've just made 7%. So understand when the greed is kicking in versus consistency. It's about progression, not always beating your previous return. That's not the goal. So I hope that helps, and I recommend that you look at that within the markets and you backtest it so you can see it for your own subconscious, and it's really going to help with your trading. But what I want to do now is dig into the next episode, guys and girls, and I hope you took a lot of notes.